All right, we are less than a half an hour from the Federal Reserve decision. You might have heard about that. They are widely expected to raise rates and probably indicate they're going to raise rates again, which all begs the question, what does that mean? What do I do? Delano Saporu knows. He is New Street Advisors CEO and a CNBC contributor. I mean, I'm not going to ask you how old you are, Delano, but it's been a long time since we have been in a rising rate environment. I mean, there's a lot of people on Wall Street that have never invested, managed money, or worked in a rising rate environment. I mean, you got to be like my age. And even I was like 4 years old, kind of, when that happened. What's your best advice right now?
Best advice, Brian. First, I want to know how many push-ups did Tyler do? Because I'm actually worried that I would not be able to beat him in a competition.
Like the Fed, he did 0.75 push-ups.
0.75. All right. Hopefully I could beat him there. So I think there's a lot of things that, one, younger investors, everyone is looking to do in this range. We talked about it last week, people calling about different things. Now clients are calling asking, when will equities ramp up again? And they're looking forward to maybe, I've always pointed to 2023 mid-year. I know some people think we'll have a ramp up at the end of this year, but I think a lot of it is actually on the Fed's decisions that we're obviously going to see, but more on the rate projections. And if that dot plot is looking towards the 2 to 3% action in 2023. So there's a few ways for us to play it, and we can go through them. Of course, you can look at, the growth in large cap names that have been beaten down over the course of this year.
Such
and pick
as?
up some that you think, yes, such as Microsoft. We've always talked about Microsoft and Apple as obviously everyone. A lot of people hold those in indexes, and a lot of people have some pure play in them. And then look at the banks; they seem to perform well, obviously in the raising rate environment. And you can look at other areas too. Dividend players, utilities. If you look over the past 6 months, obviously energy's performed the best. Utilities and healthcare not far behind, and consumer staples, which you were talking about just a little bit ago. So those are a couple of the first two areas that you want to look at for investors. And then, of course, those that don't want to stomach some volatility. We've been bouncing around the range in the S&P for a little bit. They could be in the cash. They could be in bonds, which have attractive yields currently. But there are three ways, Brian, for people to play it right now.
Timelines have got to be a huge part of this, do they not? I mean, if I'm investing for next year, I don't know, I might want to be mostly cash. If I'm investing for my kids or 20 years from now, it's a totally different story.
100%. And timeline is a big thing. I always, point to longer, but there are people and I have short-term portfolios where I'm using more short-term moves. And if you look at what we've done, the mid-June low, and we usually kind of bounce after the Fed decision. There's a pullback, and in the commentary, you'll see, potentially a little bit of bounce today. So you have to play your timeline. For the shorter-term investors, you're probably going to bounce around that range and have resistance around 3,700. But, in the long term, for people that are investing for the long term, whether it's for their kids or for themselves, there is going to be volatility, but it could clear up in 6 to 8 months when we have more clarity on inflation potentially rolling over and maybe Fed changing course a little bit.